Welcome to the Physician's Guide to Financial Wellness, the podcast dedicated to helping physicians in Michigan turn their professional success into financial success while enjoying life along the way. And now, here are your hosts, Andrew Mushbaugh and Trent DeBruin.
Hi, everyone, and welcome to another episode of the Physician's Guide to Financial Wellness. This is Andrew Mushbaugh, and I'm joined, as always, by my co-host, Trent DeBruin. And today we're going to talk about something we come across frequently with employed physicians, and that's side income from things like moonlighting, speaking, consulting, or writing. And specifically, there are some interesting financial planning opportunities available if you have that side income. So we're going to talk about what those are and how to take advantage of them. And we're always amazed at how a physician working more hours than most people work in their full-time jobs is still able to find time for some quote-unquote side income. But it's a common enough occurrence that we wanted to devote an episode to maximizing the benefits of your hard work if you are one of those physicians. And the four main themes we're going to discuss are around 1, the initial setup and organization of your side income, 2, the ways you can maximize business expenses, 3, ways you can save on taxes with additional retirement savings, and 4, how to think about investing those retirement contributions.
And Andrew, I know you spend a lot of time on fantasy football, but that doesn't count as side income.
Yeah, it really should be based on the time I spend on it. And to make things even worse, the IRS doesn't allow you to deduct gambling losses, so I just call it my annual contribution to the league.
I'm sure everyone else appreciates it.
They definitely do. And since we now know that fantasy football doesn't count as side income, that leads us to the first obvious definition of side income. It's that you actually need to have income from the extra work that you are doing. And for physicians, as we mentioned, the most common areas we come across are consulting, writing for publications, research, and moonlighting and taking extra shifts. So let's start with the first step of what employed physicians need to understand with their side income.
Yeah, so the first step is to get organized and make sense of your side income. As an employed physician, you're used to getting a salary from your employer, and then around tax time, you receive a W-2 that outlines how much you were paid and how much was withheld for taxes. However, for those with side income, you're paid directly for your services based on the scope of the work, whether that's per speaking or consulting engagement, hourly, extra shifts, etc. When it comes to tax time, in order to report that income to the government, you receive something called a 1099 that outlines the pay you received. The difference for the side income is that you're both the employee and the employer. And that means that you're responsible for paying regular income taxes on the money you receive, which we'll touch on in a second, and also paying self-employment taxes on that income. So from a tax perspective, I'm sure there are a few listeners who've experienced this firsthand, where there's a surprise tax bill after that first year of additional side income. And the reason for that is because, unlike the income you receive from your main job, where your employer withholds taxes from each paycheck, there's no one withholding taxes for your side income that you receive throughout the year. So in order to avoid a surprise tax bill, you can either increase your withholdings from each paycheck by completing a tax form called a W-4, or you can make estimated quarterly payments to the government.
Yeah, I wish we could deliver some good news that you don't have to pay tax on any of that side income, but unfortunately that's not the case.
Yeah, that would definitely make this a more popular episode. So that covers tax considerations related to side income. You're responsible for paying the taxes on the income you earn, and as an employed physician, you have some flexibility with how to pay that tax bill between quarterly estimates or extra withholdings through your work. Another aspect we want to discuss with this first step of getting organized is the idea of setting up a business for your side income, which has a number of benefits. So by default, if you don't do anything, you're considered a sole proprietor, which means you're your own employer for your side income, and that's how the income is paid, with checks written out to you. Oftentimes, especially if the side income isn't very significant, people may just go on autopilot and choose to commingle the extra income with the rest of their income in one bank account. However, that creates some additional headaches around tax time with organization, and it might also make you less likely to take advantage of deductions for business expenses throughout the year. So a better option that we recommend is to create a separate business entity for your side income, which might sound complex, but it's actually quite easy to do. You can just go online and create a separate business entity that has its own separate tax ID. And as a side note, and we won't go into the weeds here, but administratively, it's typically best to just name the business entity after yourself. And setting up a business with its own tax ID then allows you to open up a business checking account to better track your income. For all future side income you receive, you can have it deposited into your business checking account. And another important reason to set up a separate business entity and bank account is that it allows you to better track any expenses that you incur, which we'll touch on in a second in terms of how to maximize the tax deductions of your side income. And when setting up that business entity, there are several options you can choose from, but the two most common are a sole proprietorship and an LLC. As a physician, asset protection is often a much larger concern than it is for the average person, And with certain entity structures like an LLC, there are some potential additional protections available. But for most physicians, with a smaller amount of side income and no other employees besides themselves, this isn't necessary. And it's worth noting that an LLC or a sole proprietorship, it doesn't protect you from any potential malpractice lawsuits. What an LLC can provide protection for is from other liability, like owning real estate and having someone injured on one of your properties, or if you had employees and had certain issues related to them. But in general, the best and easiest route is often to just set up a sole proprietorship for any side income. As you'll see with all the different areas of financial planning, we prefer to avoid creating unnecessary complexity wherever you can. So to summarize this first step of what to do with your side income, you want to begin by getting organized, which involves 1, understanding how your income is taxed, including the ways to make sure you don't receive that surprise tax bill, and 2, setting up a separate business along with a business checking account to track income and expenses. So now that we covered the initial setup, let's talk through how to take advantage of some of the tax benefits and opportunities that are available with your side income.
Yeah, we'll start with the low-hanging fruit, which is to take advantage of business tax deductions. And like we mentioned with your side income, you are your own business entity, which means you have self-employed income and are thus eligible to take advantage of other tax benefits. And depending on the nature of your side income, you'll want to understand what business expenses you may be able to take to offset some of your income. For example, you may be able to take deductions like a portion of your office home space where you work, a new computer that you're using for your business, CME training, or traveling costs like mileage for driving. And there is a laundry list of potential items you could review, but the goal is to just be aware of and thinking about what could be viewed as a business expense for your side income. And no one likes paying taxes, and we've heard many creative ways of describing this, including one referring to it as, quote unquote, legal tax evasion. But the goal is to take advantage of the opportunities available to you to pay less in taxes. And everyone has their own comfort level with business deductions and how aggressive they get, and it's up to you to decide what's reasonable.
Yeah, I think my favorite way to describe saving on taxes was another person saying he just wanted to do his civic duty of minimizing the amount of taxes he pays.
Yeah, exactly. I think other people tend to be more creative than us with describing taxes. And outside of taking advantage of business expenses, you can save even more in taxes by using your side income to create a retirement plan. So let's touch on some of the options there.
Yeah, this is the biggest area where most physicians can really move the needle in terms of saving on taxes related to their side income. Now, we'll try not to get too far into the weeds, but we do want to at least provide a few details that are important to understand before we dive into this idea of saving more money into a retirement plan associated with your side income. And for compliance purposes, we always have to add that nothing we discuss in this show represents tax or legal advice, and you should consult with a qualified tax professional before making any retirement contributions with your side income. Now, one thing to understand is that when it comes to saving toward tax-advantaged accounts, like retirement plans, there's always a finite amount of money that you're allowed to contribute. For most employed physicians, you may be aware of the limitations around your contributions to your 403b or your 401k through work, which in 2020, the employee contribution is limited to $19,500 or $26,000 if you're over age 50. So that's the first limit to be aware of. And with your employee contribution, everyone has the same rules and limitations, where you can only contribute that $19,500 or $26,000 regardless of how many different retirement plans you have. So for example, if you have 2 separate employers, you're still limited to that one employee contribution for the year. Now, outside of employee contributions, as we've mentioned in previous episodes, most employers make contributions on your behalf as well. And these are typically referred to as matching contributions. For instance, if you contribute 5%, your employer may match 10%, as is the case for U of M, at least starting again in 2021. So between the employer and employee contributions, similar to a limit on your employee contributions, there's a limit on the total combination of employee and employer contributions. And in 2020, that limit is $57,000 or $63,500 if you're over the age 50. And one other caveat to add is that while you're only allowed to make one employee contribution across all possible retirement plans, each employer can make contributions up to that $57,000 or $63,500 combined maximum. And the reason this is important is because with your side income, as we mentioned earlier, you're both the employee and the employer, which means that while you're limited with your employee contributions, if you're already maxing out your 403b or 401k, you're still eligible to make employer contributions to your side income retirement plan. And by making employer contributions with your side income, you're able to save on taxes just like you're able to do with your employee 403b or 401k contributions.
Yeah, you can thank the IRS for making such clean and clear-cut rules there. But we already went through a lot more in the weeds than we usually like to go here, and there are more details you'll want to understand. But the punchline is to be aware of the additional ability to make retirement contributions with that side income.
Yeah, it's almost like the IRS wants to overcomplicate things to minimize how many people actually take advantage of these different opportunities.
Yeah, exactly.
So like Andrew mentioned, the key takeaway is that you want to be aware of this option to contribute to a retirement plan related to your side income. And next, you want to understand what retirement plan options are available and which one's the best for you.
So while we avoid getting into the weeds and using jargon wherever possible, we're going to throw out some more accounts and IRS codes to remember since there's just no way around it here. And the two most common retirement plans for self-employed individuals, which, as we mentioned, includes those physicians with side income, are SEP IRAs and individual 401ks. And with the SEP IRA, this is the easiest to administer and set up, and all of the contributions are viewed as employer contributions. You're able to make up to $57,000 of contributions in 2020, and similar to all other retirement accounts, you get a tax deduction for the full amount of your contributions. And there's a calculation that determines exactly how much you can contribute to a SEP IRA or I-401k for any employer contributions, and it's a set percentage based on your self-employment income, which is why we recommend talking to a qualified tax professional before making those contributions. And while a SEP IRA is better than nothing, there is a better option out there, which is an individual 401k. And with an individual 401k, as the name gives away, it's a 401k for individuals.
See, there's one thing the IRS tried to make easier to understand.
Yeah, it's true. At least there's one part that's intuitive. But with an individual 401k, you are able to make employee contributions and employer contributions, just like a 401k through work. However, like we mentioned earlier, you need to be careful with making sure you don't contribute more than $19,500 or that $26,000 if over 50 as employee contributions throughout all of your different retirement plans, which includes your plan through your other employer plans as well. And the reason we like individual 401ks better is because it doesn't preclude you from making those backdoor Roth IRA contributions. With the SEP IRA, it's technically an IRA, so that means it creates issues with being able to make backdoor Roth IRA contributions on an ongoing basis because of that pro rata rule. Again, we won't go into the details here, but you want to at least be aware of the pro rata rules when making backdoor Roth IRA contributions. And by having an individual 401k instead of a SEP IRA, you're able to avoid this issue, assuming you don't have any other pre-tax IRAs. And with the individual 401k, down the road, and once the balance is over $250,000, there are some additional tax filings you have to make, but it's still the best option in terms of the tax benefits and being able to still make those ongoing backdoor Roth IRA contributions each year.
So one other thing to note that's a little different with a SEP IRA or an individual 401k is that unlike your 403b or 401k through your main job, where you have a set lineup of investments to choose from, with these accounts, you have more flexibility with how you invest the money since you have much bigger opportunity set in terms of the number of investment options that you can choose from. And while the tax savings associated with setting up these retirement plans for your side income are definitely the biggest benefit, another benefit is this investment flexibility. With some 403b or 401k plans, you have to decide among investments that you wouldn't necessarily choose if you had other options. And while it might seem overwhelming for some people having to pick their own investments from a wider variety of options, others, ourselves included, would view this as an opportunity to access a better mix of investments. And we have another podcast episode number 5, which we'll be sure to link to in the show notes, that's dedicated to understanding what's most important to focus on with investing. But we'll at least touch on a few high-level points here of how to think about investing your contributions to your side income retirement account. And the first is to start by getting the big things right. And the biggest one being figuring out the right mix of stocks and bonds for your situation. If you're earlier in your career, maybe that means you're comfortable having 100% invested in stocks. Whereas if you're closer to retirement, you may want to add more in bonds since the time horizon until you'll need the money is much shorter. And after you have that right mix of stocks and bonds, you want to make sure your investment portfolio is globally diversified. What that means is you own thousands of stocks and bonds all across the world. In other words, not putting all your eggs in one basket. And the nice thing about diversification is that it's never been easier to achieve since there are now mutual funds and ETFs where you can buy them, and within that single investment, there can be hundreds or even thousands of stocks and bonds. Another thing you want to do is to keep your costs low. There are different costs associated with investing, and one of the big ones is the underlying cost of the investments you own. Different mutual funds and ETFs charge what's called an expense ratio, so you want to own funds with low expense ratios. For example, Vanguard has very low expense ratios for most of its funds. And lastly, you want to manage your behavior. And that sounds like the easiest, but often it's the toughest to actually implement in practice. Since you're in charge of picking your investments and investing your contributions to your side income retirement account, you want to avoid tinkering with your portfolio and also avoid some of the common mistakes, things like timing when to buy or sell investments or get in and out of the market or picking the investments that have done best recently.
Everyone likes to think that the last part of behavior management may not include them, but it impacts a lot more people than most investors realize. In a lot of ways, it's similar to pulling a room full of people and asking who thinks they are above average drivers. A lot more than 50% of the hands would probably go up. Well, we went through a lot here today and a little more detail than we usually do, but since this is such a common occurrence with physicians having side income, we at least want people to be aware of their options to maximize the benefit of that income. So to wrap up and summarize everything we went through, number one, you need to get organized, which you can do by setting up a business entity and business checking account. Number two, after you have the proper setup, you want to understand the different business expenses you can deduct. Number three, be aware of the IRS rules and the contributions you can make to retirement accounts, both as the employee and employer. From there, you'll want to understand the retirement plan options for your self-employed income, which often the best option is an individual 401k. And finally, since you're responsible for making the investment decisions in your plan and choosing your investments from among a large number of options, make sure you understand the basics of investing and avoid some of the common mistakes. We hope this was a helpful discussion to provide some perspective around how to maximize your side income. And as always, we appreciate you joining us for another episode on the show. And thank you for the time you spend with us. If you have any thoughts to share or questions you'd like to have answered, feel free to email us at info@mdwmllc.com. And you can also visit the podcast page of our website, mdwmllc.com/podcast, to access the show notes and everything we covered today. Take care, everyone, and we look forward to talking to you again soon.
Want even more ideas, tools, and resources on how to make smart financial decisions? Check out the resources section of MD Wealth Management's website at mdwmllc.com, where you'll find additional knowledge and insight from Michigan physicians, including a blog, ebook, and one-page guides. While there, you can also schedule a 15-minute conversation with Andrew and Trent to learn more about what it means to work with the firm and how they serve physicians. If you've enjoyed the content, please leave a review on iTunes and share with your friends and colleagues. Thanks so much for listening. Andrew Mushbaugh and Trent DeBruin are certified financial planners, principals, and co-founders of MD Wealth Management, a registered investment advisory firm in the state of Michigan. All opinions shared in the show are for general information and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future returns. Please consult with your legal advisor, your tax advisor, or your financial advisor before making any decisions.